Hi, we just thought we will take stock of how our recommendations have worked in about last 5 years. During the COVID time, we were overweight on equities as well as gold. On fixed income, we have been overweight since January 24. Many of these calls have gone right and some of the calls have gone wrong. But by and large, we believe we are adding value to our distributors and partners. We are in the process of launching Kotak MNC Fund. This opened on business today, and it will be open till 21st of October. One interesting thing we did this month was to release our fact sheet on the first business day of the month. My team has taken huge efforts to ensure that this fact sheet is available to you within 24 hours of the month end. Coming to global economy, inflation has started coming down across the better part of the world. This allowed central banks to start cutting rates. And in September 24, we have seen 21 central banks cutting rates, almost higher than any other time other than crisis period like COVID or subprime. Reduction in interest rates will help economy and corporates and consumers which are sitting on large amount of debt. Global debt now is about 313 trillion. This reduction in rates will support lower interest rate burden. Commodities are on the subdued side before China stimulus, and probably equity markets were reflecting on commodities bearishly before the China stimulus. Global growth was slowing down with PMI going into correction in 22 months. This interest rate reduction will support hopefully global growth. Obviously, geopolitical risks are high, especially in Middle East and Eastern Europe. This could act as a drag on global growth. China, which was going through tough time, came out with bazooka and announced $1 trillion plus stimulus package for Chinese citizens to buy equities, for Chinese consumers to buy real estate and houses. And this stimulus, the size as well as the intent, has pushed analysts to become bullish on China. Before the stimulus, like India, China announced cash handouts for the poor in rare use of aid. In India, we have to give this kind of handouts for election. In China, there is no election, and yet they had to provide this cash handouts. Chinese economy before the stimulus was losing momentum. Retail sales were coming into low single-digit growth point of view. And even industrial output was coming down into low to mid single digit. This is why stimulus had become necessary. Chinese economy has one of the highest private debt. This is comparable to many crisis-led economy. Currently, Chinese private sector credit to GDP ratio is around 200%. This in the Japanese crisis was similar, and also in other countries like Germany, UK, and US. This large amount of debt is also restricting China growth and hence the big stimulus. For us now, China matters because now China is the second largest economy in the world, and anything happening over there will have material impact on the global economy. If we come to the US economy, Fed gave 50 basis point rate cut in September, and US Fed has been maintaining adequate liquidity. Thus, it will be fair to say that US monetary policy ahead of election in November has become fairly accommodative. Will this result into soft lending? Well, by and large, US has not been able to avoid recession, but this time it looks like US will achieve soft lending with Fed's management of monetary policy. US is a consumer economy. More than 2/3 of GDP comes from consumption. And as long as consumption remains strong, US economy should result into soft lending. To some extent, US will achieve soft lending because their deficit is running at 7%. This is higher than all other previous normal periods, bearing crisis periods like Second World War. This combination of loose fiscal policy and loose monetary policy has ensured that American economy does not go into recession and does a soft landing. However, large deficit means large borrowing, and today US national debt is racing to cross $36 trillion. Look at the federal debt to GDP ratio. In 60s, it was 52%. In 80s, it came down to 35%. And today, it has multiplied almost 4 times, 225%. As you get addicted to debt, utility of debt starts reducing. Today, for every dollar of debt raised by US, they create GDP of 58 cents, or roughly half of the debt raised. The super core inflation, excluding energy and food, remains well above Fed's target of 2% at 4.5%. This also will put pressure on Fed's decision to cut rates. Normally, we have seen that equity markets rally after the first Fed rate cut if there is no recession. Let's hope and pray with both loose fiscal and monetary policy, US will do soft lending, and US equity markets will continue to rally rather than correct. if we come to Indian economy, the key headline numbers have been mixed in the month of September. Some numbers were positive, like inflation coming below RBI's target of 4%, like Forex reserve hitting for the first time more than $700 billion. But at the same time, there were certain dark clouds on the horizon. On a longer term basis, if we see, India's household debt to GDP ratio remains comfortable compared to many of its peers, including China. We are at about 36%. China is at about 62%. The corporate India also has one of the best debt equity ratio in the near term at about half or 50 basis points or 0.5% debt to equity ratio. Corporate leverage is at the lowest level in last 15 years. With corporate India and consumer India deleveraging, overall debt to GDP ratio for India remains well under control compared to many of its peers. This is remarkable, as in the same time period when debt to GDP ratio was coming down, India kept on investing on infrastructure, and infrastructure investment as a percentage of GDP moved from low of 27% in FY21 to about 32% in FY25. This infrastructure created over last 10 years is now increasing efficiency. The turnaround time in ports have come down from 10 days to 3 days. The road construction speed has multiplied 3 times from 12 kilometers of road to 34 kilometers. All these things put together has made India one of the fastest growing major economy around the world. Between CY 23 to 28, we are expected to grow at about 6.3%, higher than most of our peers. If we compare India at the same level of China when our GDP was similar to old China's level, let's say today we are 1/5 of China's GDP. At that point of time, what was China's infrastructure? We fare far better than them. Our highways are 38% of current China's highway capacity. Rail track is 50%. Rail goods volume is 32%. Ports cargo is little lower as India does not export as much. Power consumption is similar. International and domestic passengers are much higher. So there are few sectors where India is better than China when their GDPs were of comparable size. Economic activities continue to remain at all-time high. Capacity utilization is upwards of 75%, and it's likely to remain on the elevated side. Current account deficit, despite pickup on gold import, remains under control. Government finances remain stable in FY 2025 year to date. Corporate capex seems to be recovering as election uncertainty is behind. Cash flows are strong for corporates to go and invest. Private sector capex announcements have started coming through. Semiconductor, renewable energy, infrastructure, slowly and steadily, capex announcements are coming through. Obviously, they need to be executed on ground. One sector which is doing very well is electronic manufacturing sector, with components as well as finished goods. Slowly and steadily, India is inching up towards $500 billion electronic industry by the end of the decade. Thanks to Apple, our electronic exports have started rising, and this year we should be about $35 billion in exports. As production of mobile phones increases, electronic items increases, components have been, we have started manufacturing components, and slowly and steadily that component manufacturing will keep on increasing. While our electronic production as a percentage of GDP is improving, compared to other countries, it is on a much lower side. This year, we'll have about 4% electronics production as a percentage of GDP. That's half of what a tiny nation like Singapore or Malaysia makes. And it is significantly lower if we look at countries like Taiwan and Vietnam. The second support for India growth is coming from housing cycle. At one point of time, housing real estate was contributing 14 to 15% of GDP. It declined with lots of structural changes being undertaken by the government. It came down to mid-single digit, and now it is on the way to double-digit numbers. The third factor which is supporting India is Global Capability Center. Last year, GCC exports was about $26 billion. And this year, we could be looking at upwards of $30 billion. GCCs are creating employment and also supporting our current account deficit. Everyone knows success of engineers, especially in software on the export side. Not many people know that Indian chartered accountants are also doing a great job in global capability centers. Entrepreneurship is slowly and steadily picking up. Now there are more than 100 startups which are unicorn or having valuation of more than $1 billion. Monsoon has been fairly good, bearing some parts of North and Eastern India. Overall country has witnessed above average monsoon with 8% surplus rainfall. The Kharif crop will be about 2% higher than last year. Jute and mesta and cotton will be witnessing large drop, but pulses and paddy will witness significant increase. What are the risks for Indian economy at this point of time? The first is consumption. Other than last quarter, preceding 4 quarters before that, consumption growth was lower than the GDP growth. This is the first time when consumption growth is higher than the GDP growth. Will this trend continue? We need festival season from Onam to Dasera to Diwali to Christmas, resulting into bumper consumption. Second challenge for India remains employment. Undoubtedly, we are creating jobs, but not well-paying jobs. Lot of people are employed in agriculture without adding real value. Undoubtedly, India needs to create well-paying jobs on a much higher scale than what we are doing today. In our Kundli, Rahu and Ketu is oil prices. With Middle Eastern oil have started moving up. It is well below our forecasted number of $85 a barrel taken into budget calculation. But certainly we have to keep one eye on oil prices. One final risk, the September numbers have come down suddenly. For example, GST collection growth was 6.5%, below nominal GDP growth of 9.7%. Many of the high frequency indicators like automobile sales, cement sales, real estate sales have shown sharp decline in September 24. Corporate income tax collection crashed by 36% in month of September. Slowdown in high frequency data, below nominal GDP growth in GST, and sharp drop in corporate income tax collection raises antenna. Is economy slowing more than expected? Some people say slowdown in economy is because of rains. It restricted cargo. Some people are attributing it to drop in exports as container rates have gone up. We'll have to wait and see what happens in this festival season. Some two-wheeler company will witness 40% of their annual sales in 40 days between Dasera to Deepavali. Next month is very, very crucial from a recovery and growth point of view. Let's hope and pray this festival season does not disappoint anyone. Coming to equity markets, market cap to GDP ratio at 146% is on the higher side. Average for last 20 years is about 84%. We don't think market cap to GDP ratio is going to come to this level, as profits have jumped almost fourfold in last 4 years. Between 2010 to 2020, corporate profit increased from 3 lakh crore to 4 lakh crore, about 33% increase. Market barely moved from 62 lakh crore to 113 lakh crore. Next 4 years, market moved from, corporate profit moved from 4 lakh crore to 15 lakh crore. Market cap followed. As this profit to GDP ratio is at upwards of 5%, we don't expect market cap to GDP ratio to do mean reversion. In 2020, profit to GDP ratio was 1.6%. In aggregate, 4 lakh crore of profit. Today, it is 5.7% of GDP, aggregating 15 lakh crore of profit. This profit is reflected into cash flow and liquidity on balance sheet, with corporate leverage coming to lower level in last 15 years. The return on equity for corporate India, despite higher cash balance and lower leverage, remains healthy at 15%. The street expects Nifty to deliver FY25 EPS of 1100 rupee, growth of 10% over FY24, and then about 1300 rupee growth of 18% over FY25. The first quarter EPS for June 24 came at 265. This quarter it is expected similar. So between June and September, if we are going to see earning of about 530 rupees, then for the rest of the 6 months, we need earnings of 570, which is easily achievable. Valuation wise, large cap, mid cap, small cap looks like they are trading above historical averages. But please remember, low PE stocks in government and B2B companies have moved out, and high PE stocks like Titan and Trent have entered, and which is why this averages look on the higher side. Adjusted for B2C companies entering index, this number looks reasonable, not very expensive. The domestic investors continue to support market, and we have seen some heavy FPI selling in first 5 days of this month in October. Between cash and FNO, FPIs have sold 78,000 crore. Today's number could take it up to 1 lakh crore. And yet domestic investors are absorbing the selling, which gives stability to the market. Will FPI continue to sell relentlessly? Well, if you look at what they have invested between CY21 to CY24, the total FPI investment came at 15%. Total domestic investors came at $105 billion. That's almost 7 times more than what FPIs have invested. This gives us confidence that FPI's ability to sell will be constrained, and they will look to sell at higher level rather than during correction at lower level. FPI have been buying and selling in a cyclical manner. CY22 sold $17 billion. CY23 bought $21 billion. This year, in the month of Jan, April, May, and October, they have sold. But in the month of Feb, March, June, July, August, September, they have bought. At this point of time, market is discounting many things positively. US Fed cutting rates, coalition government remaining stable for 5 years, oil prices remaining around $80, consumption recovering in festival season, geopolitical risks not escalating, and earnings growth remaining in double digit. All these things are positively discounted by the market. If it continues to come as per the expectation of market, then markets will continue to rise. But if any of these expectations are not met, we will see correction in the market. One interesting thing is the absence of buy ratings on the market. There was a time during FY19 to FY22 where more than 100 stocks were buy in NSE 200. Today, that ratio has come down by half to about 61 stocks. It does show that market is discounting future fairly positively. A lot of earnings, a lot of return in stock market came because of expansion of PE ratio. Earnings growth was 13% in large cap, but overall return came thanks to 19% expansion in the PE ratio. We believe now the re-rating or valuation driven rally is behind us, and depending upon how companies pursue profit, their stock prices will move. The mid and small cap as a percentage to GDP is at the highest level. Mid caps are at about 27% to GDP. Small caps are about 29% of GDP. That's significantly higher than historical averages. This is the most important chart. Between 05 to 24, over 20 years, return came from market at about 13%. But last 5 years was 21%. And before that, 15 years was about 11%. We don't believe this kind of return is possible going forward, as valuations are near their fair value. We believe returns are more likely to be somewhere between this two space, which means investors will have to moderate return expectation while investing in market. At this point of time, our view on equity market remains neutral weight. Correction is great opportunity to build or add to your portfolio, and within that be overweight large cap and underweight small cap. In terms of opportunities, our rolling return performance of various equity funds shows outperformance over benchmark index. The same is true in hybrid funds. On a point-to-point basis, across our funds, by and large, we are adding value and outperforming benchmark indices. On an SIP point-to-point basis, again for majority of our funds, we are outperforming benchmark indices and adding value to the investors. Two funds which are worth pursuing in today's environment: Kotak Technology Fund. We believe IT sector should witness faster turnaround and better volume as well as value growth as sales cycles come down, and integration of AI into various software like ERP opens up opportunity for Indian companies. Kotak Consumption Fund is something we are recommending to investors. In a falling market, these funds are likely to outperform. And now at this valuation, consumption as well as technology looks attractive to invest. In the equity side, do look at funds like Kotak Equity Opportunity, which is large and mid-cap fund, or Contra Fund, multi-cap fund, and quant fund, which have delivered fabulous return and outperformance over benchmark index. As I mentioned earlier, we are launching MNC Fund from today. For us, MNC is companies which are subsidiary or joint venture of a foreign company, or it is an Indian company which derives majority of its income or assets from outside of India. So for us, Hindustan Lever is MNC because it's a subsidiary company of Unilever, and Infosys is also an MNC, as more than half of their revenue comes from exports market. By and large, MNCs have characteristics of having good brands. Lever, Nestle, Maruti, they all have very, very strong brands. They are technological. They are in leadership position on technology thanks to their parents' investment in R&D. By and large, MNC attracts quality talent. They become factory of CEOs for their parent companies, group companies, as well as other companies. Most of them have good capitalization and financial stability. This combination of great brands, technological leadership, talented management, and financial flexibility makes MNC darling of investor. Another thing to watch out is that in MNCs there is limited supply and also low float, as many a times 75% is owned by parent and only 25% is available in the market. Put together, our MNC fund provides an opportunity for investors to invest with 5-year plus horizon or through SIP. This fund should outperform on the way down because of the defensive nature of its holdings in FMCG and MNC. And on the way up, it should deliver returns in line with broad market. I also want to highlight portfolio of our passive funds across large, mid, small. We have various funds like Nifty 50, Nifty Next 50, Nifty 50 ETF, and so on and so forth. We also have smart beta mutual funds, index funds, ETFs on momentum, low volatility, alpha, and value. We also have thematic index ETF funds on financial services, IT, consumer, MNC, tourism, and housing. And we also have gold and silver ETF and index funds. We also have offshore funds like Kotak Nasdaq 100, which is available for investors to invest into offshore market. We also have bouquet of product on the debt fund side. As Kotak, we are there in both active management as well as passive management. On the fixed income side, Fed is expected to cut twice this year and 4 times next year. Fed's cutting rate is putting into precedence a template for all other central banks to follow. And we do expect world to move to lower interest rates compared to what is prevailing today, but it will be higher than what was prevailing during subprime crisis. India's CPI numbers continue to remain soft, and it has come below the estimate of the RBI. RBI has been managing liquidity quite nicely, and from deficiency in the first quarter of current year, they have ensured that there is adequate money available for call money market. Rupee remains well anchored thanks to RBI's intervention and accumulation of reserves. Overall, this is time to go and buy longest possible maturity. We have been giving this call for some time. Long bonds have rallied, but still there is some juice available for buying duration in mutual fund schemes. If we look at debt schemes, we have a couple of hybrid schemes which could be important for debt market, for debt investors to invest. For a shorter term horizon, Kotak Money Market Fund will be appropriate. For high taxpayer balance advantage fund or equity savings fund will be appropriate. We are also coming out on 29th of October, Kotak Income Plus Arbitrage Fund of Fund. This will have 60% investment in debt and 40% in arbitrage. Combination of that debt plus arbitrage will enable this fund to provide tax incentive to its investors as per the regulation. Keep a watch on Kotak Income Plus Arbitrage Fund of Fund. Maybe some of your investors will like to invest into this fund. On gold, we have been bullish for some time. Barring 2021, our call has gone right. Gold prices are moving up, driven by Indian housewife and central banks around the world competing with each other in buying of gold. In the month of August, we saw $11 billion worth of gold getting imported. It's substantially large number for India. In fact, highest ever monthly import. We believe gold prices will get supported if US interest rate starts coming down. That is what has happened in the past. And maybe this time history is repeating, as falling US Fed rate will support gold prices.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.